We will review the chapter number 1 for the topic bank management and financial services. We are going to be using the 9th edition of the textbook. The first chapter is discussing the overview of the changing financial services sector. We'll discuss what the financial services firms do, how do they generate the profits and revenues, as well as discuss some of the regulatory changes that are affecting these types of companies. We will spend about 70% of the time during the course discussing banks. These are one of the largest financial services companies. We will also spend time on insurance companies, investment banks, mutual funds, and other financial services companies, but less time will be spent on that. So let's discuss as an introduction what are banks and financial services companies. I will interchangeably use the term financial institutions, financial services firms, or banks. We are essentially referring that to be the same types of firms. The assets that are held by U.S. banks represents about 1/5 of the total assets of all financial services companies. That includes insurance companies, investment banks, etc. Let's first discuss what are banks' assets and what are banks' liabilities. It's important for us to understand that unless you have worked for a bank before. Bank assets are essentially loans they give out to customers, individual customers as well as business customers. Also, banks' assets are securities, investments in securities. Banks, by law, are only allowed to invest in U.S. government bonds, as well as some other country bonds, countries that are more developed countries. Banks are not allowed to invest in any corporate equity, neither are they allowed to invest in corporate bonds, just government bonds. Banks' liabilities are deposits that the bank holds on behalf of their customers, individual customers like you and I, as well as business clients who maintain deposits. Banks use these deposits to give out loans to customers and also to invest in securities. Banks' function essentially is rather important for the financial system. Banks do not print money. However, they accommodate funds to be distributed from the depositor to somebody that wants to borrow the money. And that is known as the system allows them to improve the financial services of the country. There are different types of banks that you may hear of. They are all essentially the same. The reason why they have different banking types is because these banks perform various functions. So for example, if you look at this list here, a money center bank is also a commercial bank. The reason why we call a commercial bank a money center bank is because of the fact that the particular bank is headquartered in a large financial center such as New York, Boston, San Francisco. There are also smaller banks called community banks. They provide the same services as the commercial banks do, except they are rather small. We have savings banks, we have cooperative banks. Cooperative banks tend to provide services to mostly farmers for agricultural purposes as well. Banks provide mortgages as well as provide investment services. So you notice the fact that all of these names represents the different types of products and services that the same bank offers. The key difference is there are smaller, mid-sized, and large banks out there. Money center banks, as I've just pointed out to you, these are the industry lenders. They are the largest institutions, and they provide a much more diversified products and services throughout the country as well as internationally. They have a much larger organization structure, a broader product line compared to community banks that are much smaller. An example of a community bank is Evans Bank, Evans National Bank here. A large money center bank is, for example, Key Bank or HSBC Bank. Banks, we call them, they have a legal basis to operate. The reason for that is because they take our deposits and they lend that money out or invest. They have to be mindful of how they lend the money out to individuals and businesses, and they have to be mindful about making sure the investments in securities are relatively safe. The other legal basis of banking is that the deposits are insured by the Federal Deposit Insurance Corporation, up to $250,000 per person per account in individual banks. There are other roles that banks perform within the financial system. They provide what is known as a payment services role. What that means is the fact that if you are buying something from a store and you use your debit card to take the funds out of your account, the bank will provide the service whereby they will take the funds from your account and provide the funds to the merchant that you're buying the goods from. That's the payment services. Means they are paying the money, your money, to the merchants because you purchased something from them. They also provide risk protection services. As I pointed out to you, they must make sure the fact that any investments they make or any loans they give out are relatively less risky. And they provide liquidity services. That means the fact that they provide money, funds. They do not print money, but they provide money that we deposit in the bank to companies as well as individuals that need to borrow that. All banks have become rather complex because of regulations, as well as they become more competitive. They now are more known as financial services companies because banks offer more than just deposits and loans. They also offer insurance products, investment banking services, as well as mutual funds and hedge funds. So their product line has expanded dramatically. These are the different types of products and services that various banks offer. They provide money market funds, hedge funds, mutual funds, investment banking services, insurance products, etc. We now call banks more financial services institutions, mainly because of the 1999 Law Act that was passed in the United States as well as all over the world. This 1999 law allowed banks to offer different products and services that we just spoke about, such as insurance, investment banking, mutual funds, etc. So they compete directly with these types of financial services firms. These other financial services companies, such as insurance companies, investment banks, such as Morgan Stanley, Goldman Sachs, insurance companies such as MetLife Insurance, AIG Insurance can also offer banking products, and banks can offer their services as well. So there is really no difference between products and services that are offered by banks versus other institutions as a result of the 1999 law. As you can see here, commercial banks have roughly 24.6% of all bank assets as of 2010. There are other non-depository institutions, as we spoke about, insurance companies, as well as investment banks, mutual funds, real estate companies. These also are known as financial services firms, but they hold relatively smaller percentage of all assets. Assets of insurance companies are essentially investments. Insurance companies, unlike banks, can invest in corporate securities, such as corporate bonds and corporate stock. They can also invest in government bonds as well. The liabilities of an insurance companies are their customers' premiums, essentially the liability that they owe back to the customer if the customer decides to purchase insurance from a different company. Investment banks' assets are also various investment services, such as corporate stocks, corporate bonds, and government bonds. All of these insurance companies, as well as investment banks, can also provide loans that commercial banks can provide. Investment banks' liabilities are investable funds that investors provide to the investment banks or the brokerage firms to invest on their behalf. There are other services that financial services provide. They provide currency exchange, which is foreign currencies, as well as they provide trust services. More of these will be discussed in later chapters. Again, all financial services companies now operate on the same level field. They can offer each other products such as loans, deposits, insurance policies, investment services, etc. In general, we call these financial services firms, all of the financial services firms, not just banks, to provide what is known as an intermediation role. An intermediation role means they are the middlemen. They take your deposits and they provide those funds to a company who needs to borrow money. So they are in the middle. They provide those securities to both us as depositors and to companies in the form of loans. They provide the payment role, whereby if you purchase something from a merchant, they provide the funds to the merchant from your account. They guarantee deposits as well, up to $250,000. They make sure the fact that they invest in lower risk assets, as well as they can invest in various types of securities as well. They have a safekeeping role, whereby your deposits are safe at the bank, essentially. Here are some examples of financial services firms. They all provide the same services. There are banks, as well as insurance companies, finance companies, as well as brokerage and investment firms. These are some of the largest financial services firms in the world. There has been some changes occurred in the last 8 years since the financial crisis of 2008. Quite a bit of regulations have been passed because of the financial crisis. In the past, governments used to deregulate financial services firms. Deregulation means they were allowed to offer whatever products they wanted to offer. Now it has changed. The governments across the world are now are regulated rather. That means the fact that they're becoming more stricter in the regulations, limiting the services that financial services firms can provide, mainly to reduce risk and to avoid a similar financial crisis that we had in 2008. That concludes chapter number 1.